Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In the last few months, we've had so many new members in our community. And one of the things that a lot of you have asked me was, you've asked questions that tells me that you are starting your investment journey right now. And one of the reasons I have started in this whole YouTube thing was to kind of help everyone that is either starting or thinking about starting in this investment journey, right? And I also share my journey with you guys. Just be transparent. Just like what you see right now is my portfolio. It's still going up and down every single month. I think the last time I did a video, it was lower than what it is right now. I haven't actually added any money this week. So I still need to add the £250 for this week. But yeah, so just to be transparent and so on. And one of the things that I want to do today is to go back to good old days where we look at the S&P 500. The reason I want to look at the S&P 500 is so when you're trying to basically build a portfolio, you want to do such a way that it basically reflects the S&P 500 sectors. So you've got some companies in the technology companies, in the material sector, in healthcare and consumer discretionary, consumer staples and so on. And the reason is because you want to have a diversified portfolio, and that's what I'm trying to do here. So majority of my portfolio is basically different companies, but obviously majority of my money is in technology companies because that is what I know best, right? But at the same time, I'm trying to basically build a portfolio that's well diversified. So what I'm going to do in the next few videos is probably this week and next week, try to release as many videos as I possibly can, just looking at the top 5 companies in each sector. So we'll look at technology, we'll look at healthcare, we'll look at all the other sectors and pick 5 Sharia compliant companies that you could potentially invest in. And this doesn't mean as a financial advisor or anything like that. What I want you to do is just maybe look at these 5 companies and maybe pick 1 or 2 that you really are comfortable and you understand their business and so on, right? So what I'm giving you is just the overview that you then need to go into detail, then look at each company, look at their 10Ks, how do they actually make money? How much have they made in the last 10 years, right? Do they pay any dividends? Is that dividend actually covered? Is it safe? Some of these things I'll share it with you, but some of it you have to do those research. So I'm going to look at all 11 sectors. Some of them are very easy because there's so many Sharia compliant companies. Basically sectors like utilities is very difficult to find any good Sharia compliant companies in there, but I will try to find as many as I possibly can, and I will share it with you guys in the next few videos. If you like this type of content, right, please like the video, subscribe to the channel, and let me know if you have any questions. Okay, some of these companies we've already spoken about, some of them are very new, so we'll see how that goes. And like I said, I'm going to look at all 11 sectors, and then hopefully we'll kind of build a portfolio of stocks that you could potentially pick from whenever you're basically doing your own research, inshallah. The one thing I want to talk about today is the earnings. So this week is probably one of the most important week because some of the big companies are reporting. So companies like Microsoft is reporting today after the bell, right? The Alphabet is reporting, Visa is reporting. Then we got Texas Instrument. This morning, UPS have reported, Coca-Cola has reported, and 3M have reported already. We've got GE also reporting. We've got West Management tomorrow morning and a couple of other companies. And then in the afternoon, you've got Meta, Teladoc, and so on reporting. KLA, another company that I used to own in my portfolio. Thermo Fisher is actually reporting tomorrow morning too. Shopify, MasterCard, Merck, a company that I own in my portfolio. Then you've got Amazon, Intel, and then you've got the big boys reporting on Friday when it comes to oil. So Exxon and Chevron, as well as AbbVie and so on. So there's so many great companies, but the ones that we really need to watch out is Microsoft, Alphabet, and Amazon. Apple, I think, is reporting soon as well next week. So no, why am I saying actually? Look, Apple is actually reporting. I didn't even see that. It's reporting Thursday straight after the bell with Amazon as well and Intel. So it will be a really interesting week to basically see what happens to the market, because if any of these companies come out and if they say something that is the markets are not expecting, right? If they give it even a guidance that are not great, and they basically say, oh, the next quarter or the next year things are not going to be the same, and they cut down their guidelines, then we are in trouble. The markets will tank. But obviously, God knows what's going to happen in this market, because right now the way things are is very, very strange. But UPS have reported this morning, 3M have reported this morning, and the rest of them will be reporting this week. So if you're interested in any of these companies, it might be a good time to kind of have some cash lying around and then wait for that opportunity. For example, if you own Visa and you want to add to it, you might actually get an opportunity if they report earnings that's not great. Same goes for Microsoft. Same goes for, I don't know, any of the oil companies or MasterCard or any other company. Merck, I'm actually looking forward to it, because this is a company that I own in my portfolio and it's actually done really well for me this year. I mean, since I actually bought this company, it used to be, if you remember back in the days, if you've been with me for the last year and a bit, you know this company has always been in the red for a very, very long time. And what was I doing? I was buying it almost weekly. I was buying it every single month. I was adding to it. Now I've got 27 shares, but right now it's up almost to 50%. 50% up. So anything can happen. So it will be interesting to see if I get another opportunity, because I would like to have another three stocks of shares of this company, but we'll see. That's my average right now. I don't want to average up because there's so many great companies in my portfolio that I need to average down on. Right, so the next thing we're going to look at is these 5 companies, right? So today we look in the technology sector. So that's the biggest in the S&P 500. In fact, let me just quickly show you the S&P 500 breakdown so you know what I'm talking about. We got the communications, we got information technology, consumer discretionary, stables, energy, financials, healthcare, the industrials, and then material, real estate, and utilities. These are the 11 different sectors. So we will look at each one of these. And for today, I'm looking at the S&P 500 sector, the technology sector. I looked at the Vanguard ETF, which I will share with you at the end. Just quickly before we finish with the earnings section, I just wanted to touch base on the about 3M. So 3M reported better than expected earnings, but the revenue was actually down a little bit. Okay, and their guidelines is actually not great. For that reason, I think the stock's down a little bit. UPS, different situation. It actually went up, okay, pre-market, because they actually report they beat both. Revenue was actually short. Basically, in terms of, they was slightly down in comparison to what the expectation was, but they beat their earnings. But the most important reason, the reason why it's actually going up, is because of this. Okay, because of the profit margins and the fact that the guidelines was actually better. Basically they said they haven't changed their mind. They still expecting to report by the end of the year whatever they said at the beginning of the year. So nothing has changed. Whereas companies like 3M actually said, you know what, it's not going to be as good as we thought because of the strong dollar and other things that are happening to the company. So just want to finish that off before we move on. Right, so we're looking at the same things again here. So the first company we're going to look at is Microsoft. Microsoft, it has wide economic mode, $247 per share. It has a dividend yield of 1%. Latest dividend increase was almost 10%, which is really huge. 5-year growth rate of 10% and payout ratio 27%. So this tells us it actually has room to increase that dividend if you like. Dividend streaks basically for 12 years. Okay, safety 99%. That's the highest any company gets. Profit margin 36.7%. Free cash flow $65 billion and total return of 25% in the last 10 years. Growth expectation for the next 5 years in terms of earnings, we're looking about 5 years. The next 5 years is 15% every single year. Morningstar is saying right now it's about 30% discounted, $352 per share. This is one of the companies that I've spoken about for so many times. And now some of you ask me questions about the Sharia compliance side of things, so I will comment on that in a bit as well. The next company we're looking at is Texas Instrument Incorporated. A really great company. They do have basically they do a lot of the chips, if you like, and basically analog to digital devices. They have a wide economic mode, $161 per share, 3% dividend yield, which is very big in terms of technology companies. Okay, what you would notice is as we go along with this, you will see technology companies do not actually pay a lot of dividends, right? But when you look at companies like the consumer staples, consumer discretionaries, the utilities, they have a very high dividend yields, but their payout ratio is very high as well. But these companies, this is what I love about them. Okay, so they have a lower payout ratios, but their dividends not that huge. But right now, this company over 3%, 7.8% increase, the latest one, 21% in the last 5 years, and it still have 48%. So they have room to improve that if they wanted to. 18 years of increase in that dividend, safety 90%, profit margin of 43%, and free cash flow here we're looking at about $5.8 billion. Total return in the last 10 years about 11%. In growth, next 10 years expected 10% growth every single year, fairly valued at the moment, which I completely agree. $166 per share is where basically the price should be. Right now it's 165, 161. So if it goes down quite a bit, I might look at this company again for my family portfolio. I'm not sure, so we'll see how that goes. Broadcom is another company that I own in my portfolio, $456 per share. Over 3.5% dividend yield, which is absolutely crazy for a technology company. They have increased, the latest increase was 14%, last 5 years 43%. Now let me tell you one thing, even though the payout ratio is quite low, I don't think that's sustainable. I don't think they're going to carry on doing this. They're sooner or later, they're not going to cut it, but they will slow down slightly. They're not going to increase it 14% every single year. But 47%, that tells me they can still increase if they need to, because they do have some cash lying around. And dividend streak, we're looking at about 11 years of increasing that dividend, 67% safety, profit margin 31%, free cash flow $15 billion, and total return in the last 10 years, we're looking at 32%, 15% growth expected next 5 years for earnings. Okay, 27% discounted right now, $624 per share. Right now is $456 per share. The next company we look at is Cisco. Again, one of my favorite companies out there right now. I'll be honest with you. I've been buying quite a bit lately, and I will be buying as long as it stays below $50 per share. I am definitely a buyer. 3.549%, almost 3.5% dividend yield, 2.7 increase in just recently. That's not a lot, but for the company that's been around for a long time and only started paying dividends about 11 years ago, that's okay. Okay, because I'd rather the company buy back a lot of their shares, and this is what the company do. So they buy back. Do you know what buyback does for us, right? Two things. When a company buys back their own shares, okay, it does something for us, which means basically our one share is now worth more, right? And also the company, it will help them because they don't have to pay dividend for that basically stock that one share they bought back, right? So it gives more money back to the company, but at the same time they give us more. So hopefully if they can increase that dividend, that would be really nice. So then hopefully the next increase, if it's like, I don't know, 4 or 5%, that would be really nice. But hey, only 45% payout ratio, which is absolutely fine. Dividend streak 11 years, safety 91%, okay, profit margin on 23%, free cash flow of $12.7 billion. And that's probably one of the reasons I think this, especially if recession times and so on, the fact that the company is going through a transition from its normal hardware kind of devices to obviously network hardware devices to now more of a software subscription. I'd rather the company reinvest that much, right, this money into the company than actually increase their dividends, which is absolutely fine for me, because in the long run, the price appreciation will cover that if you like. Okay, 12% total return in the last 10 years. Growth estimate in the next 5 years, 7%. Discounted right now at 19%. $54 per share is where it should be. Now, like I said before, I own it, and I will be adding to it in the next couple of weeks. Next one is the company I own as well, Qualcomm. $116 per share, 2.58 dividend yield. Latest basically dividend increase was 10%. In the last 5 years, they have increased it 6%, payout ratio 23%, dividend streak 18 years in a row, safety 80%, profit margin almost 31%, free cash flow $6.6 billion. Total return in the last 10 years, we're looking about 9%. And the next 5 years, every single year, we are expecting the earnings to grow about 11%, 29% discounted, $163 per share. Right. Every single one of these companies are absolutely amazing. And like I said, I own 4 of these companies. The only one I do not own is Texas Instrument, and it's definitely on my watch list. Whether I add it to this portfolio or the family portfolio, I would love to add this company at some point to my portfolio, not because of just the dividends, but obviously the fact that they have an excellent free cash flow. They have been around for a long time. They have a wide economic moat, so they seem very stable company that I could potentially have in my portfolio for a very, very long time. And that's why I'm thinking to add it to possibly to the family portfolio if it goes below, I don't know, 150-ish, if something happens. So we'll see when they report, because they're reporting today after the bell. So we'll see what they say. I'm going to watch obviously I'm going to listen to their earnings call, and we'll see what they report, and then we'll take it from there. But like I've always said to you guys, this is not financial advice, and it's really important that you do your own research as well. This is my own opinion. Again, the fact that I picked 5 companies from this list, okay, in fact, let me quickly show you that list so you know exactly what I'm talking about. This is the Vanguard and Information Technology ETF, and if you click portfolio and scroll down, it gives you overview how much it basically is in assets and all of that stuff. But this is the bit that you need to look at, how many companies within that are from application, software, and so on, so on, so. And then if you go down, you can see the companies itself and how many shares basically that is in this ETF. So I picked companies from this list. Okay, Nvidia we talked about recently, so I didn't actually include that. But you've got Nvidia, you've got Visa, you've got MasterCard, you've got Broadcom, Qualcomm, etc., just CRM, Texas Instrument. And by the way, we're not only going to focus on different companies, some of the basically sectors. I might actually leave out some of the companies that pay dividends if I can find another one that doesn't, right? So you got Adobe's, Qualcomm. So there's so many great companies within that ETF that are actually Sharia compliant. With other sectors, you will notice this. It's not the same, right? It's not the same with other sectors because of for a million reasons, right? Like I said, I will show you what these companies look like when it comes to Sharia compliant. And as you can see here, right, it says according to Zoya, 33% Sharia compliant, right? So that means about 7% of this company is actually not, and 5% of that is questionable. That questionable part comes from the Google, not Google, look at it, I've already said Google, Bing, right? So the Microsoft Bing, which is the search engine, has some sort of advertisement. That advertisement, as well as the LinkedIn advertisement, that is the reason why that 5% is questionable. But when you look at the revenue from that section, it's not actually 5% or anything like that at all. It's very, very small from the advertisement side of things. For that reason, I am comfortable, right, holding this company. Again, you have to make your own decisions. You have your own opinions, okay? I'm not saying this is basically you have to follow me, but I'm just giving you the information. You do whatever you want to do with it. But the rest of the companies, okay, there's absolutely fine, 99%, 100%, and so on. And that's overview of the interest-bearing debt, interest-bearing securities, and everything you need to know. And I will do the same thing for every single company we look at from now on. I think next is either healthcare or consumer staples. I can't remember, but I will be recording that at some point either today or tomorrow, and inshallah I will release them. And as soon, what I want to do is get these videos as soon as I can out to you guys, so at least then you've got bank of videos that you can watch. If you're interested in consumer staples sector, then you can look in that sector and find out some of the big companies that are in there that have a basically good balance sheet. And again, I'm giving you a snip, basically just literally a quick snapshot of basically what these companies are all about. But there's so much you need to look at, and you need to go to these companies' financials in detail and look at every single thing before you put your hard-earned money. Really important part. I hope you're enjoying the video. If you are still here, can you let me know, right, what companies that you own in your portfolio from the technology sector, right, that you think I've not spoken about or I missed out, that would be a great addition to my portfolio or your portfolios, okay? Again, it's not financial advice from you, but it's just to give us some ideas of some of the companies out there that you potentially own, or you potentially want to own. Have a wonderful day. Assalamu Alaikum.